Okay, hello everybody, and thank you for coming. So this is joint work with my former PhD student, Mahnaz Paydarzarnaghi, who was at the University of Texas, Arlington, and now she is on the faculty at Roger Williams University in Rhode Island. I'm David Rakowski from the University of Texas at Arlington. We also have Mahmut Yasar, who is our econometrics guru at the university on this. And this is I have two papers here back to back. So this is the first half. The second one is really the second half. So I might mix them together a little bit. It's a social media paper drawing on Twitter data, but it's supposed to be general to the rest of social media. I've tried to minimize the regression tables on here and give more of an overview of some of the interesting things about social media that might be, of note to those of you who either work on social media or don't work on it, whether you're an academic or not. And here we're looking at social media credibility and investors trading behavior. So this is getting at the credibility of posts on social media. So some of the things that we're attracted to here, trying to answer or look at is, first of all, the big question is, what do investors pay attention to in the context of social media? What actually then drives their trading? So we want to know what they notice and then whether it actually results in a trade and it goes through the financial markets. And in particular, the characteristic that we are looking at is what makes a social media post credible. And we look at that from a couple different dimensions. So social media, of course, important in financial markets in a couple different ways. Sharing financial news shapes people's opinions out there in the markets. It's also important to be able to measure this so that we know what market sentiment is. We know retail trading is disproportionately driven by sentiment on social media. And one of the things that social media helps with is it provides a new source of information that investors can access more easily, because a lot of posts on social media are easily tagged with cash tags, which lets you know exactly what it's referring to in terms of a stock ticker. Okay, problems with social media though that have not, so the last slide has received a lot of attention in the academic literature. These choices have received much less attention, or these characteristics here. So the problem with social media is, we know it's just riddled with fake news, inaccurate information. It doesn't have the same vetting as the traditional old-fashioned media, which is not perfect to start with, but there's a lot more problems with social media. So there is some research out there showing stuff like false information spreads exceptionally quickly on social media. It spreads faster than legitimate information. So some studies have suggested that the more fake some news is, the faster it spreads on social media. And the more accurate it is, the slower it spreads. We know that there's lots of things like rumors that spread very quickly on social media, even more so than in the traditional news. And also, we know that different social media platforms, and I think Twitter is now, or X is now the case in point, is that unverified or badly verified content is out there, and it can sometimes masquerade as pseudo-legitimate content, which it is not. Okay, so the research questions, what we're looking at. How does the perceived credibility of Twitter posts actually influence stock returns and stock trading volume? More in the next paper, stock trading volume. How does the type of credibility, and what we do mostly here is we decompose credibility into a lot of underlying components or characteristics. The two main ones is credibility of the text and credibility of the actual person sending that message. And we want to see, does this strengthen or weaken its influence on stock returns? I think I say, compared to traditional media, social media has all these problems, but again, in a location like this in Lithuania or a lot of this part of Europe, we know that in times past, the traditional media was not all that accurate anyway. It was often a propaganda tool, which I guess our president in the US says that's what it is right now too. And feel free to interrupt me, jump in if you have any questions or want to discuss any of this. I'm ready for it. So hypotheses that we're looking at here. Communication, acceptability, and influence, just motivation for what we're building up to here. They depend on a recipient's sense of communicator's reliability and trustworthiness. So there's a lot of research out there showing that trust for the messenger is important to whether you act on their message or not. We know that tweets containing opinions can influence stock returns by providing credible information. We have seen this out there in the research. And trust affects the stock market's response to news. This is what ties what's on social media to actual capital market outcomes. So first basic hypothesis in simple terms, credibility is positively associated with the effect of Twitter activity on stock returns. So the more credible the message, the more impact it's going to have. I got cut off a little bit. Now, the second hypothesis is built on a much more detailed model. This idea of trust for a communicator or a sender and credibility of a message, this is not something new. This is we have a whole field of communication science, and especially in education also. This has been around for a very long time, and in marketing, there's a lot of research on it. It's somewhat new in the context of finance, or not new, but not really studied all that much. There's a model called the elaboration likelihood model, which is about 60 years old. So we draw on this, which basically, it says there's a central route and a peripheral route to any message or any information received. The central route is basically motivated, analytical, highly involved. You have processing, high level mental processing commitment, persuasion, long-lasting attitude change likely. What it's saying is that this is, in our context of behavioral economics, we have the work by Daniel Kahneman, which has something comparable to these, thinking fast and slow. You can think of it as qualitative and quantitative. You can think of it as emotional and rational. The central route here is the rational, quantitative, thinking slow route. Yes?
It's a simple pedantic thing. You can fix the persuasion.
Mm-hmm.
Spelled twice.
Yes.
For the next time.
Yes.
Just
Good noticing. Yeah. You're right.
Because I think, what is this persuasion? It's like Asian persuasion.
No, you're right.
It's just misspelled.
I know, it's because I took it as an image here. Yeah, you're right. Thank you. Let me fix that next time. The peripheral route, this is the emotional route. So this is quick, very quick thinking, emotional, qualitative rather than quantitative. It's a different pathway for information. So we're trying to basically put Twitter behavior or Twitter post behavior into these two categories and compare their effects on financial markets. This hypothesis is a bit more detailed. So tweets influenced by the central route of persuasion, that is the credibility of the text, are going to have a longer lasting impact on stock returns. They might not have as much of an immediate reaction, but they're going to be more sustained over time, compared to this peripheral route, which we expect might be bigger immediately, but is not going to last over time, meaning it's going to be reversed over time. And that would be the sender credibility. Okay, so Twitter data, if you're not used to it, this is using the old Twitter, and I'm calling it Twitter because it was Twitter when we used it. It's X now, but if you're not familiar, when it converted to X, that's they basically shut down the academic data access. And they also instituted a lot of policy changes, which totally changed the nature of credibility on the platform. So we're using this when it was Twitter. That's 2019 through the end of 2022. We get daily stock data from CRISP, analyst coverage and earnings dates also in Google search volume as control variables. This is examples of type of Twitter post we're looking at and a user profile. So this is a Twitter post. It's got some stuff that we look at. So we're looking at the cash tag. So this one's tagged for Amazon. So when you have the $sign and the ticker, that's referencing a stock quote out there. It's got an image in it, which is something we use. We do text analysis on the text. And then we take the user profile, which is given here, and we take all the data from the user profile, which is kind of one of the newer things that we do, including image analysis, name analysis. We look at how many people are following, how many followers there are, and what the location is. If there's any links or anything else to a profile, to an outside website. We're trying to capture all that information here, which is stuff that's not been looked at in detail in many of the other papers that look at Twitter or social media. So again, another example of a Twitter post. So for the Twitter data, what we get, we restrict ourselves to the S&P 500 stocks. We could get many more stocks, but we in particular want to focus on stocks that otherwise are large cap and have information out there about them. So we get text, timestamps, images, embedded URLs, and then we also get engagement metrics, which include likes, reposts, and retweets. Okay, example of user profile, that's our co-author here, Mahnaz. Profile details that we get, verified status, profile picture, name, username, location, join date, bio description, URLs, and in a follow-on paper, we do a whole bunch of additional AI and machine learning analysis of profile pictures. Activity metrics, all the stuff about their tweeting behavior over time and what their profile has accomplished on there. Okay, so the components of how we break down credibility. First of all, we break it down to central and peripheral, that is text characteristics and user characteristics. So what we look at, text characteristics further come down to clarity and substance. So clarity at its kind of granular level, this is looking at readability and language tone. So two different aspects that we run various natural language processing and text analysis measures on to extract those two separate components. In terms of content, we're looking at the different type of multimedia that might be there, whether it's a link to an outside website or any other type of media, such as videos, pictures, if there's audio on there, which is, there's not usually audio, but sometimes there'll be audio on Twitter. So we look at all the different types of we quantize the measures of what's in the actual message there. For senders then, we have links to a different type of either a biography or a home page or any other thing, LinkedIn page, something like that. Whether it's actual text description, because you can put a description on your profile page on Twitter, whether it's a verified account or not, that's the blue check on Twitter as it was back then, and whether they actually give a geolocation, which these may or not be, they could make up all this stuff, but whether it's there or not is what we're checking first of all. We run principal components analysis on a lot of this. So we put it together to extract the main components. We do a lot of diagnostics with that, which I won't go into the details on it. Basic measure, or the model, what we come up with then is we're taking different measures of returns. I'm just going to report raw returns here, also alpha, risk-adjusted returns. We look then at tweets, at credibility, and the main thing we're interested in is the interaction. Whether the interaction between tweets and credibility leads to a meaningful difference in terms of the impact on returns. And we look at returns over different horizons or windows. So in the literature on social media, a lot of the problem is the contemporaneous reaction is hopelessly endogenous because tweets cause returns and the returns cause tweets, which within the same time period, it's really difficult to separate one from the other. But we can use that contemporaneous as a relationship as a benchmark then to see how much of that is reversed over time and how much of it is sustained. So we care more about what happens in the days following. So we aggregate this up to daily data. We've done intraday, but the results are all for daily data. And we mostly want to see whether any reaction just persists over time or gets reversed.
Do you have a measure of whether the tweet is positive or negative about this?
Yeah, well, we've done a lot of sentiment analysis. We do have that. I don't have those results in here right now. The tweets are overwhelmingly positive, though. It's something like 90% are bullish or positive. So it doesn't make a huge difference. We can control for it, and we have, but we didn't find that it added a lot. So we don't have any of that in here now. But yes, we can do that, and we have done that. And we did have that as one of our measures in there. And we basically found getting rid of it didn't make a big difference. Now, extracting the negative ones is a whole separate story, and we have a separate study that's looking in more detail at that. I mean, it's a good point, but it doesn't seem to make a lot of difference with what I have here right now, at least. Yes?
Could you construct another measure of credibility that is actually predictive of return in the past?
Yeah, so kind of like a track record?
Yeah, exactly.
Yes, there's some issues with that. There's a problem because when so we're going to have to aggregate all this you start out, the raw data is at the post level. So you have lots of posts. For any given stock day, we're going to have then lots of posts about that stock on that day. When we aggregate it, something like a track record that's in the individual user level, we could. So what we're getting let's say a social media stock day profile. So for each individual stock day, we're going to have whether that firm on that day has, say, more clearly written tweets or more vague tweets. But a track record, we have to know if that firm on that day has a user base that has an accurate track record or a less accurate one. We have played around with that. Also, I don't have that in here, but that's a good point. And I know it's something that we've looked at in the past, and I'm not sure what happened to that analysis, if it got lost somewhere in it, but it's good to remind me of it to go back and look at that again. I'm gonna have to ask Mahnaz. This results in, at the stock day level, 500,000 observations roughly once we're aggregated up there. We start with, it's roughly 50 million tweets that get aggregated into that level. The characteristics here are typical for other studies on Twitter and social media. They're within the normal range of a lot of these things. And a lot of our measures here, again, they're not necessarily easy to interpret the numbers on these because they've been run through a principal components analysis. But those are some of the things that we decompose the measures into. Again, we look at, so some of the terms that'll come up, liquidity, reversals, and information. Basically, a liquidity effect is something that gets reversed. Information is something that doesn't. So this is going back to the Barber and Loafer and Barber and Odin kind of methodologies and looking at whether information leads to actual sustained change in price or whether it's just price pressure that gets reversed once the trading subsides. And my graphical drawing of that is, so what we're looking at is time t equals 0, you get a Twitter post, the price goes up over some window, and often it's really just over day 0. Part of it then gets reversed. So the reversal, price pressure, overreaction are all referring roughly to the same thing here. And the information is then kind of the change to the new price level after our window. And we take a window here of 14 days. We don't find there's much after that 2-week period. That's it's 14 trading days, so it's really about 3 weeks. And we don't find much after that. So in terms of a baseline model, if we take text credibility, what we're interested in most is this interaction and essentially whether it gets reversed, whether this day zero effect gets reversed over time. And that interpretation of the magnitude, though, you have to kind of sum the coefficients, which is a little bit less intuitive. So the idea is when you have credible text, you get a boost in your returns. However, much of it is reversed over time. Actually, it's more than reversed. So you get a boost in returns, but it's an overreaction. So people do respond strongly to it, but they overreact. So when tweets are both numerous and with credible content, they provide some information rather than just liquidity shock. It stays over time. Sorry, I have all wrong rows. That's the text credibility. The impact, the simple just having text credibility gets reversed. Having simple tweets gets you a big day zero impact. But the part that's sustained, it's only sustained if you have that interaction. So when you have the interaction, you get less of a reversal or more of a sustained change in price. So if you want to get a sustained change in price, the tweets have to be credible. Or graphically, the green bars are the cumulative change in the price in terms of the information that's permanently impounded into the price. The blue and the red columns are basically what gets reversed here. So Twitter impact on its own leads to a bump in price, but it gets reversed by the end of our window. If you just have credibility, but with no actual volume of Twitter activity going on, you get a little boost, but it's reversed. If you have both credibility and you have actual activity on social media, you get those prices that permanently are affected and changed by it. So it does seem that text credibility represents meaningful information out there in the markets, and you get a much better signal if you filter out by this. Yes?
Does this research data have kind of like the dynamics of the upvoting of a tweet? So let's say somebody says Amazon is going up, and then every day it goes up, people upvote that tweet.
So we have looked at reposting of it. So the reposts are a more powerful thing. So on Twitter, you can't really upvote it, but you can repost it. So it'd be the equivalent. And reposts give a much stronger signal. And also to repost, I mean, when somebody, I think the bigger issue there is that if you put a tweet, you don't know if anybody ever sees it. So tweets are out there, but they might be completely ignored, or they might be nobody ever sees it. But in order to get reposted, somebody has to see it to repost it. So it's not just a measure that they approved of it, but it also verifies that somebody actually saw it. Actually, somebody saw it and somehow, absorbed it and decided to act on it somehow. So that does give a much stronger measure. We don't have those in there because they're actually so much stronger that this is, I guess, the kind of conservative result. But retweets are always give a much stronger result with this. So interpretation of it. If you want economic interpretation, if we crank through the transformations of what those coefficients actually are, if you take firm day observations with tweets at the 90th percentile of text credibility, they're going to have stock returns on the day after that are 1.347 basis points. So it's about 3.5% if you annualize it, higher than stocks that are just at median text credibility with the same amount of tweet volume going on with them. So it's a moderate, I'd say it's a moderate, it's not small, it's not immense, but it's a reasonable moderate effect size there. Now, price pressure from non-credible tweets reverses after a couple days. So if you have, whenever there's tweets, it gives you a price impact, whether it's credible or not. But if they're not credible, it gets reversed after a couple days. If you have credible text, but there's no engagement, so you might have credible, like well-written text about your firm that you're following, but nobody's acting on them, then it also gets reversed. But if you have credible text and there's a lot of activity with them, you get the sustained price change and price response there. So that's the kind of main result for text. And that's what we expected, because text is this quantitative, rational, slow-thinking thing. It should be putting information out there, but it's information that takes time to digest. So it is consistent with the theories out there from information and communication science. Now, if we look at senders, we get a somewhat different result. It's similar. With senders, basically, if you have credible senders out there, so I guess it would be well-known or respected users posting about your firm, or your firm has a social media profile that is, say, respected or at least followed people making posts about it, you get a big bump. It's a little bit, it's more so that, you get a little bit less when you have the activity with it at time zero. So it's mostly coming from that user profile. And then it's not really sustained as much. You get some of it here, but the magnitudes of these are smaller than it was for text credibility. So you get somewhat of an effect, but when tweets are both numerous and they originate from credible sources, they provide information, also leading to sustained market response, and they don't just do a liquidity shock. But it is a little bit different. It's smaller in magnitude than it was for text, and we want to compare both of them to confirm that here. So you can see a little bit better here. The dynamics are different here. It's not so much the tweet volume that gets reversed, which it does. It's the user profile that's more important, which the user profile should be more important here possibly. But you also get this response. It's slower, that it's understated at first, but over time you do get a bit of a sustained price change when you have credible senders, but it's much smaller in scale than it was for text credibility. So impact of sender credibility, it's weaker than the impact of text credibility. The price pressure is weak. You don't get as much price pressure, and it does reverse. The presence of credible users is positively associated with returns, even when you have low levels of activity and increased activity by credible social media users. It's just giving you a much weaker price impact than it was for the text. We put them both together here. This is what we see. We get somewhat of a continuation with the interaction for text. We get much less, except for something happening at day t+2 with sender credibility. So we can conclude from this, at least, and a lot of other tests that we have in the paper there, that the central route is going to be more sustained on stock returns than the peripheral route. And when we put both of these in here, the initial reaction at day 0 is much stronger for users, which, as we expected, because that's the emotional immediate response. But then the sustained kind of component of that is stronger for the text credibility. Okay, so we add in some additional tests. I'll just skip some of them. My slides, I don't know what happened here, but we look at Twitter disruptions. I can skip this or come back to it afterwards. We do basically an exogeneity test to identify this. It's consistent with what we have, that when Twitter is basically suppressed or not working properly on a given day, people pay a lot more attention to the credibility of the text. So when you have unreliable Twitter access, text credibility becomes a lot more important. Okay, so what we had there, credibility amplifies the impact of social media on stock returns. Investors react more to text credibility than to the messenger or user credibility. It permanently influences returns, though only when there's actual activity. And so kind of implementable conclusion is investors respond more to a clear message rather than just to the trusted messengers. So if you're an influencer, that's less important than just the firm having clear information out there. So I guess clear information matters more than the messenger. Questions about it?
You don't control for news on those days.
We do. We did a couple different controls for news. The one we have in there is Google search volume. So we tried a couple different measures of controlling for news. Google search volume worked the best, and so we have that in there as the main one now.
I wonder, are these tweets just repeating information from other news sources?
Yeah, well, I mean,
They
yeah.
add information into it.
No, there seems.
That's not tell.
Yeah, this is all controlling for Google search volume. So we do control for that. So this is some kind of marginal effect above and beyond what's in the news out there. We did it at first with Bloomberg News summaries, and we had that as a control. And then Google search volume is what we have in there now, is recommended for us to use as a kind of more comprehensive measure of it. So we are controlling for that in there. Other ideas for how to improve it?
Well, so you did the text, you did the sender, but also you didn't do anything about the stocks. So I presume different stocks may have a different clientele. So let's say fake news may be more important for
Yes.
meme stocks as opposed to for like a utility companies or something like that.
That's true.
Maybe some sort of splitting the sample or something on the stock type of sentiment.
That's a good point. That's true, and that's kind of what we follow up with here. I have two, so this is the second half of it. So there's a second half coming. We have stock fixed effects in there. So we do, at least we have stock and day fixed effects. So it's controlling for the overall level of stock, but I mean, it is true that there's the distribution of Twitter attention or Twitter posts, it's very skewed. It's there's basically a ton of tweets on a handful of firms, and then there's nothing for everybody else. And it's not necessarily related to market cap. I mean, if you did it by I guess we call it tweet cap or, tweet weighted what's out there. You'd think that GameStop is like, the fifth biggest firm in the world when it's tiny actually. And then you have some firms, whatever, Johnson & Johnson, I think had the lowest, I guess, I think we call it tweet deficit at one point. And when we looked at it in terms of its amount of tweeting compared to its market cap, essentially it's a big firm, but nobody tweets about it. I guess it's boring. Procter & Gamble is the other one that's big and boring. Nobody tweets about it. But then again, that's predictive of what happens over time because those firms have shrunk a lot in terms of their share of the market.